Hey everyone, good afternoon or good morning, depending on what time zone you're in. My name is Jack Mannon from BMC's Marketing Communications team, and I'll be moderating today's webinar. On behalf of BMC, Meyers Research, and Zonda, and today's presenting sponsor, Weyerhaeuser, I want to thank you for joining us for our September Market Intelligence webinar. This is the first in a monthly series, which will feature industry experts sharing their insights into macro and micro level trends shaping the home building and home buying market in 2020 and beyond. Two quick administrative notes before we get things rolling. First, there will be a short 3-question survey at the end of the webinar. Your feedback is very much appreciated and will allow us to edit and amplify future webinar content to make sure we're hitting the topics that you guys want to hear about. Second, should you have any inquiries during the presentation, feel free to use the Ask Question feature on the right side of your screen. That's going to chat me your messages. We'll have a formal Q&A session at the end of the webinar where I'll read back your submissions to the presenters. Now transitioning into why we're all here today. Customers across the nation are looking for information on how to navigate the market and supply chain, and we are here to help. With that said, I think that's a good segue for me to turn things over to Mr. Ross Thielen, VP of Sales and Marketing for Weyerhaeuser.
Thanks, Jack. Thank you for the opportunity to sponsor today's event. At Weyerhaeuser, we're proud of our long-standing relationship we've built with BMC. Together, we work hard to support builders like you who are busier than ever building homes and other wood frame construction projects. I want to start by acknowledging the tight supply many of you have experienced with products we produce like lumber, OSB, and truss joist engineered wood. I'm proud of how our company has kept employee safety at the forefront of how we operate in the face of the COVID-19 pandemic. There's no question the pandemic has altered all of our views on how 2020 would unfold. On top of that, many in our industry have dealt with recent hurricanes and wildfires. All of this has occurred in a market where channel inventories are lean and demand is very strong. These factors have contributed to supply chain disruptions, and I expect many of you have seen that directly. In spite of all these things, I want you to know our operations are running well. We're making and shipping product. So simply put, we're working hard to keep you building. I want to take a moment to share an overview of Weyerhaeuser Company. Weyerhaeuser Company began more than 100 years ago with 900,000 acres of timberland, 3 employees, and a small office in Tacoma, Washington. Founded in 1900 by Frederick Weyerhaeuser, we've grown to become one of the largest sustainable forest products companies in the world. We are comprised of 3 main businesses, as noted on this slide. We believe trees are a remarkable resource that can and should be managed responsibly to make a range of products that meet human needs. Many of you use lumber, OSB, and engineered wood we produce from fiber grown on these timberlands. Our real estate, energy, and natural resources business complements our timber focus by enabling alternatives that help deliver the most value from every acre. In wood products, where I've spent my 24-year career, we operate 18 distribution centers that serve the top U.S. markets and 35 manufacturing facilities in strategic locations across North America. We aim to create long-term relationships with our customers and end users built on the belief that you value a supplier with quality products who shows an interest in understanding your business, including how we can help make you more successful. We have a diverse portfolio of quality products at compelling scale with a geographic reach that allows us to reliably deliver to the markets where you build. We do that through important partners like BMC. So finally, I'll conclude my remarks by highlighting sustainability at Weyerhaeuser. Sustainability has long been core to what we do and how we do it. We recently announced our 3x30 sustainability ambitions, 3 big challenges facing the world that our company can help solve. And our commitment is to make tangible progress in each area by 2030. We know we can't solve these challenges alone, But we also know our vast forests and the essential products we make put us in a unique position to move the dial and make a difference. I draw your attention specifically to our homes ambition. Wood products from Weyerhaeuser can help meet the growing need for affordable and sustainable housing in communities all over the world. I believe this audience has firsthand knowledge of the benefits of building with wood, and I invite you to learn more about our home's ambition by visiting our website at weyerhaeuser.com/sustainability. Thanks for making time in your day for the presentation today. I'll now hand it back to our MC, Jack Mannon.
Hey, appreciate it. Thank you so much, Ross. I now would like to invite BMC's President and CEO, Dave Flitman. He's going to share a few thoughts on a few matters. One of them I hope he'll cover is the announcement of the transformative merger that was announced last month between Builders FirstSource and BMC. Dave?
Thanks, Jack. Thanks, everyone, for joining today and for your business and certainly for your partnership. We appreciate it very much. And, 2020 has been a year of unprecedented challenge, both personally and professionally for many of us. And for that reason, we felt it was timely for our team of experts today to team up with Meyers Research to bring you our current insights on the state of the market. And I believe today you'll find that both informative and insightful. And as Jack mentioned, I thought I'd start with just a short revisiting of our merger announcement. As you likely heard, on August 27th of this year, we announced that BMC and Builders FirstSource will combine to create the nation's premier supplier of building materials and services with more than $11 billion in annual sales. Together, BMC and Builders FirstSource will have approximately 26,000 associates and operate a leading network of 550 distribution and manufacturing locations that spans 40 states, and it will bring us closer to you and all of your job sites. This combination, importantly, will enable us to go deeper with technology as we continue to innovate with our core capabilities and deliver even more value-added products and services, from ReadyFrame and our Pro Remodel offerings to structural components, and importantly, our millwork doors and windows. Just a brief update on the merger since the announcement. Our teams on both sides are moving forward to finalize our diligence, and integration planning has kicked off and has begun. However, and this is important, until the deal closes, we are still two separate companies. Our focus at BMC continues to be on competitively running our business and servicing our customers. And while BMC is not immune to the current supply chain challenges, we continue to work closely with both our customers, like yourselves, and our suppliers. First of all, staying close to our customers is absolutely key. Understanding your future demand, particularly over the next 90 days, is critical in terms of staying ahead of the supply chain issues that we're all facing. With lead times on OSB and lumber pushing 4 weeks or more, it's imperative that we understand start expectations well in advance to ensure that we have the product available. Understanding customer demand helps BMC identify future risk areas and get ahead of those proactively. The BMC team has participated in multiple customer webinars over the past 90 days and is conducting future online activities as well. Also, staying close to our suppliers is key. In many cases, we may be talking to suppliers weekly, and more frequently than that, sometimes daily. Understanding supplier challenges and the impact those challenges may have with the product for BMC allows us to mitigate potential customer impacts. Our supply chain team can then pass that intel on to our field leaders on a weekly basis. In categories that have a diversified mix of manufacturers, we are expanding relationships for the long haul. We are establishing secondary suppliers across those categories everywhere that we can. However, in some categories, that's simply just not an option. And finally, managing metrics and other intelligence. We are constantly reviewing our service levels, both from suppliers and the service that we provide to you, our customers. Lead times is also a key metric we review from our suppliers, and understanding where our suppliers are in terms of hitting that expected lead time and back order commitments allows us to make firm commitments to the builder in terms of the timing of our deliveries. While we continue to request our suppliers expedite and prioritize BMC needs between hurricanes, COVID-19 and wildfires out west, it's a challenge for sure. But I'm very grateful for the strong relationships we have with all of our suppliers and their ability to help us service you. We're expecting availability to improve slowly over the coming months. In the meantime, we'll work hard to ensure you have the product that you need. With that, I'll turn the webinar over to Tim Foster, who leads our millwork procurement. And Tim certainly has had his hands full in 2020. Tim?
There we go.
There you go. There you go.
Thank you, Dave. Well, you can see by my picture there, I've got a lot of gray hair, and when you've been around as long as I have, you think you've seen it all. 2020 proved me wrong. I haven't seen it all. 2020 has been kind of an imperfect storm on the supply chain side. In the next few minutes, where I talk about the key categories in millwork, doors, windows, molding and boards, and finish hardware, one of the recurring themes is really the touch factor in making these products. And the higher the touch factor in 2020, the more the supply chain was disrupted. So let's go into the next slide. Please, Jack. So doors. Everybody on this call, if you use interior molded doors, you got touched in 2020. Again, that imperfect storm really has come from manufacturers having labor issues and not being able to produce the number of doors that the market is requiring. At the same time, the demand, particularly from the big box stores, Home Depot and Lowe's, their demand is up about 35% at a time when the industry could not make the normal number of doors, much less an increased demand. Compounding that problem, the industry was placed on allocation for doors. It varies a little bit, but we were getting 60 to 70% maybe of the doors that we would like to get. And a further compounding factor is skin supply. Molded door skins have, since the big crash of 2008, about 9 million doors, molded 18 million skins, 9 million worth of doors have left the industry capacity-wise. So skin supply is tight, door assembly labor is tight, and demand is up. So that's really what led to the significant supply chain disruption we've had on interior doors in 2020. Windows, again, they're a high-touch product to make. Demand from the big box stores, which, believe it or not, comprise almost 50% of window usage in the US. Demand up 35%. Labor to build windows way down. So we have seen lead times go from anywhere, a standard 2 to 4 weeks, depending on the manufacturer and zone. We are now seeing 6 to 12 weeks being pretty standard. Price increases have already been announced. I expect more to come in the next few months. On the molding and boards category, this didn't get a lot of press, but on January 5th, 2020, a petition was filed by an organization called CAMP, which is a coalition of American molding producers. They filed a petition with the International Trade Commission against China and Brazil. China has, over the years, become one of the dominant suppliers of a couple of millwork categories, namely exterior door frames, pine boards, and small moldings. That investigation took place over the course of 2020, and in early August, their findings were announced, and tariffs against China on average of 250% were imposed, which really removed China as a viable supplier of those products. While some tariffs were expected, I think those levels were very surprising and The industry has been scrambling to replace that production coming from China. I would say the most problematic categories right now are exterior door frames and finger jointed boards. Those are in the tightest supply anyway, and we are seeing price increases of 40 to 50% on those two categories. A somewhat lesser effect on finger jointed moldings. There was some capacity in South America, and by the way, the Brazil ultimately got no tariffs assigned. So everybody in the industry is scrambling to South America and Indonesia and Malaysia, other countries to fill what was coming out of China. But again, exterior door frames and finger jointed boards, largest effects, 40 to 50% increases, probably 25% or so on finger jointed moldings. Let's see. We've got finished hardware under the molding and boards category there. Schlage and Kwikset dominate that category. Both of them cast their products in Asia and bring those parts to Mexico, where they are assembled and then distributed in the United States. They've actually been okay on the components manufacturing side, but assembly in Mexico was very problematic. Almost all Mexican businesses were shut down for some period of time early in COVID, and these hardware manufacturers were no exception. Again, we saw lead times go out from a 3 to 4 week standard lead time, and without really any notice, moving out to 7 to 9 weeks. That has, and we lived with that lead time for some time. That has since gotten dialed back a little bit. I would say Kwikset's about 5 weeks now, and will soon be back to a 4 week lead time. Schlage's also working hard, but they are still 6 to 7 weeks and are probably a month away from getting back to a 4 week lead time. So that has been another pain point in getting houses closed. We realize that and are doing everything we can to mitigate that disruption. Next slide, please, Jack. Okay, so what's BMC doing about these problems? How can we ask you to, help us help you? You heard Dave mention it, more lead time. Every category in the millwork world has had extended lead times in 2020. We have extended our lead times out. We've been trying to build inventory. That's tough. That's kind of like trying to build the plane, while it's flying. But we kept the pedal to the metal. We've kept trying to increase our inventories with some success, finally. More communication. Again, Dave kind of stole some of my thunder on these points. We are talking to our suppliers, our key suppliers, key categories, certainly every week, in some cases every day. We're asking for as much communication from you, our builder customer, with your BMC salesperson as possible. We use the information that you supply to your sales guy to drive, our inventory levels. And we take that information to heart and use it. More flexibility. Some of the problematic categories are flat panel molded doors. We are saying, hey, if a particular item that you normally would use is in tight supply, maybe consider other options. Let your BMC salesperson show you maybe a different door design that we do have easier, a better supply of inventory, easier to get product. Maybe a molding that you use normally. Maybe we don't have that molding, but we have something similar that is in good supply. So again, maybe just show some flexibility in what products you're willing to use, and that can help us help you. And the last thing is we are working BMC towards more standardization of products in the supply chain. We are trying to help our manufacturing partners be as efficient as possible. So we are trying to standardize any small differences that we have between our products and between our regions, so we can help be as efficient as possible to get more product with the labor available to manufacture it. That was a lot. That's what I have. If we have any questions that come in, I'll be happy to answer them. Thank you.
Hey, thanks so much, Tim. Now we're going to turn things over to Mr. Thom Black, Senior Director of Commodity Trading for BMC. Tom's got nearly a decade and a half of experience in the industry and has his finger on the pulse of what's happening in the world of framing lumber, structural sheathing, and specialty wood products. Thom?
Thanks, Jack. You can see from my picture, which is pre-COVID, not as much gray as my friend Mr. Foster, but definitely a lot more today than the past. So Jack, thank you again. Let's go ahead and get the first slide queued up. While you're doing that, I want to say thank you to Weyerhaeuser for their support of this event. And also a special thanks to all the attendees taking time to participate. We've got a lot to cover, not a lot of time, so I'll get right into it. To start our conversation today, we wanted to lay out some framework on just how different this year has been from previous market runs. This move, which effectively started in April, tripled the market's value to current date, gaining more than $600 per thousand since the start of Q2. When we overlay this year, which has been called unprecedented way too many times, and there's really no other word for it, but every time we thought it would, we were at a new inflection point, it just continued to show us tight supply. But when we overlay these previous bull markets since 1995, we can clearly see just how different the current environment, this unprecedented environment, is, comparatively speaking. This move has effectively demonstrated in the graph on the right, which is effectively demonstrated in the graph on the right, which plots out the number of weeks on the horizontal axis of a run, and then the total market appreciation on the vertical axis from the starting point. You can clearly see in this that not only have we gained more than the previous 6 bull markets, but we have done so in a much shorter timeline. So with something so extraordinary, what are the drivers of this unprecedented market run? Going to the next slide, Jack. On this slide, you will see that we have broken out the events that have shifted our supply and demand balance, making this year so different. And while all 6 of these have played a significant role, we'd like to focus our time here today on numbers 5 and 6, what we refer to as the wild cards. While all 6 of these, again, did play an instrumental role, the first wild card was the entire industry curbing inventory growth in anticipation of lessening demand when COVID reared its head. North American producers this year showed just how agile they had become at controlling product flow. It had become very apparent very quickly that the production shifts which occurred in 2019 helped to create a rapid response plan throughout the industry. It was noted by my counterpart as well as Dave at the onset of the call, the amount of communication. This has been called by a man smarter than me a communication event. And in talking with many of our suppliers, many of them had a playbook on how to handle exactly the production outflow and what levers to toggle, right? And again, they did so effectively when they thought that housing starts were going to, go to zero based on some industry analysts. That second wild card, number 6, was the unexpected surge in home center demand caused by Americans' desire to tackle home improvement projects in the face of quarantine. We'll cover this further in the slides ahead, but during the quarantine, we saw a higher level of home center demand, and as some producers who service this segment noted throughout the latter half of Q2 and early Q3, in some regions that demand was up over 100% year over year. So Jack, let's go to the next slide. Just a little shout out for those that are interested in those other 4 bullet points. BMC has started cataloging an index on our website of this write-up as well as other ones that will help you manage your business. Again, you can find that on BMC's website, and these market intelligence blogs get posted weekly. Jack, let's go to the next slide, please. But back to the impact of the increased home center demand, we thought, go back one. We thought we'd show just one example that the working remote environment had on lumber products in 2020. As those lines began to wrap around the garden centers nationwide, we saw a notable shift begin to take place. Historically, new home construction prefers longer lengths of lumber, 12, 14, 16 foot for the builders on the call, very familiar with this. And those lengths based on the demand of new housing construction usually call a premium. Due to the surge in DIY projects, we saw 8-foot products not only trade at all-time highs, but all-time relative highs. Meaning, as depicted on the graphs on the left, we saw 8-foot products, which usually trade at deep discounts, near parity. That graph on the upper left, the orange line represents 2x4 8-foot spruce, and the green line represents 2x4 16-foot spruce. You can see that both moved up significantly. But in the graph on the lower left-hand side, you can see that what you're looking at is the spread between the two products. And while historically, since the beginning of 2017, that spread between 8-foot and 16-foot averaged $91 per thousand, in early Q3, it got as small as $5 per thousand. This spread compression can be oversimplified by noting that anything 8-foot fits better in a minivan than anything 16-foot. So this is just one example of the impact of home centers. So we have those 6 contributing factors. What have they brought us? Well, to a market clamoring for do-it-yourself projects. For do-it-yourself projects while housing bounced right back from the lows of COVID scare in March and April. We have a V as depicted in the red line in that graph. That represents housing starts. Pertaining to the correction on commodity products used in home building, they can only be described as a super V, as depicted in the costing of 2x4 number 2 spruce in that blue line, which is that straight vertical jump like you saw on the year-over-year bull market graph represented earlier. While currently some products are becoming more available, this varies significantly by species and region. Some of the upper grades still being very tough, and both Ross and Dave mentioned the forest fires at the onset of the call, with some fir products being incredibly tough right now. And while cash markets are still experiencing a hangover from the bottleneck that was caused by the home center demand in the face of lessening production, we have the CME futures market, which has been experiencing significantly high levels of volatility, with most of that pressure being to the downside. And in the next, the forward curve from last Friday, which depicts cash pricing as well as futures pricing. Cash pricing being on the left side of that graph, and futures contracts for each month being depicted sequentially moving from left to right. You can see that they're all trading at significant discounts to today's current cash market, with November somewhere between 35 and 40% lower than reported cash numbers. So what's next? If we look to the past, futures has acted as a leading indicator for cash market movements. These arrows that you see indicate futures movement on the blue line, followed by cash movement by the red arrows moving down. So if we assume that futures is going to play that same role, and we look to previous periods to help outline seasonality's impact, perhaps 2003 through 2005 can give us some insight into what role seasonality will play with the constrained market conditions that we are in, despite very strong demand from most segments. You will note that in 2003 and 2004, which were both very, very robust years, not only for pricing at that time period, historically speaking, but also for housing, as everyone on this call will remember, you will see that while demand was strong and we had that seasonal pullback, it was followed by a swift reversal both of those years. So if we utilize the idea of futures being the mechanism that leads the market down based on perception of weakness, but availability does not substantively change, we could see a notable divergence between reported prices from random lengths and what producers are actually willing to sell, right? That graph that is on the screen right now depicts the blue line is where 2x4 cost, number 2 Western spruce is, so far year to date, with the orange line being, at least right now, a directional forecast. So in closing, should the fundamentals of housing remain healthy into Q1 and the home center, the DIY demand return after the first of the year, because let's face it, for those that have been in a home center, you know that post-Halloween, the priority shifts to rock salt, snow blowers, and Christmas trees, depending on where you are. However, their priorities tend to shift right back right after the first of the year. So if those demand fundamentals of strong housing and DIY continue to remain strong for the balance of the year, while futures may be in a down mode right now, the wild ride of 2020 could carry over into 2021. And it is at least our team's impression that the market is going to continue to be unprecedented and very, very hard to predict so long as this terrible virus is with us and the overall supply chain remains constrained. So Jack, that's everything that we have on the commodity side today. I appreciate the time and more than happy to answer some questions when time allows at the end.
Really appreciate it, Thom. Nice work there. Lot to digest. So now allow me to introduce Ali Wolf. Ali is the chief economist for Meyers Research. And if you haven't had the chance to hear Ali present before, you guys are really in for a treat. As the head of the economics department, Ali manages and analyzes the content for Zonda, provides data analytics, runs special research projects, and does presentations across the country on topics spanning from both the housing market and the wider economy. Ali has focused a lot of her career on understanding prior recessions and led the change on millennials, discussing millennials in the home building space. Ali, I'm now going to pass control over to you so that you can present your slides.
Awesome. Thank you, Jack. And hello, everyone. Those were some great presentations. I really, really enjoyed that, both Tim and Thom. There was really good content that you guys covered. I'm here to kind of hit on some of those similar trends, and almost by accident, my presentation basically backs up what Tim had said, is you're seeing all these supply chain issues, and there's a really real reason why that's happening, and we'll talk about that from the demand point of view in the home building industry. Sorry, that changed. Okay, you can see my screen fine, sorry for asking, but right?
Yep, we can see your screen just fine there.
Perfect. Okay, cool. So, and then before I dive in, I do want to thank, of course, Dave and Janine and Jack and the entire BMC team for having me here. As mentioned, I am Ali Wolf, the chief economist with Meyers Research. If you're not familiar with us, we're a housing data and consultancy firm, and we're known for tracking 18,000 actively selling communities across the country. And so we have a good sense of what markets are selling the best, what price point is selling the best, what do people care about with unit size, what do people care about with lot size. So we spend a lot of our time manipulating that data. But besides that, we have 275 housing and economic metrics that we monitor. Now, my job as our economist is to step back and say, what is going on internationally? What's going on nationally? What are we seeing with policy? What are the strongest housing markets in the country? How does economics play into the housing market? I have to roll that all together to get a good sense of where the market's heading. So we're going to cover a lot today. I have about 30 minutes. I'm going to go fairly quickly through this data to get through these 5 sections. We're going to start with just the backdrop of the economy, go into the standout sector, which of course is housing. We'll go into the builder landscape, some of the demographics behind the strength today, and then I'll hit on some final both economic and housing thoughts. And the way I want to start this is in normal economies. And as you heard both Thom and Tim mention, like, we are in unprecedented times, so it's hard to say what normal is today. But in normal times, you look to the labor front to give you a good sense of housing demand. Usually job growth and household formation are closely linked. Well, we're seeing a huge gap from that reality if you look at some of the jobs data. Now, thinking back to March and April, we lost over 20 million jobs. There was a fear that we were going to fall into a depression. It was really some of the worst times I think a lot of us have lived through, at least when you're looking at the economy. But then, starting May, we started to add jobs, and we've continued to add jobs, albeit at a slower pace. So for August, we added 1.4 million jobs, and this is what it looks like. We had that initial really quick snapback in May. Those were the low-hanging fruit jobs that actually continued through August, but now you're starting to see that growth slow a little bit. Now, one thing that I focus a lot of my time on is I don't want to just tell you about the headline numbers. I literally, on the Friday morning, I get so excited when this jobs report data comes out, and I sit and I read through their press release to find out what else. We know the headline numbers. So one of the interesting things, for August, 20% of all the jobs that were added were temporary census workers. So that accounts for 300,000 of that 1.4 million. The reason I bring this up is especially when I talk to mortgage brokers, they say, well, those 300,000, yes, they're getting added back, but those jobs are temporary and those people are unlikely to be buying homes. So this is really good for an income buffer, but you always have to look at the numbers in context. So for example, we have 50% now of all of the jobs that we lost in March and April that have returned through August. August is the most recent data we have available. Watch this Friday. This is when we get the September jobs report, and you need to be looking for at least 1 million jobs added to feel comfortable that the economy is continuing on a pretty solid pace. But if it's 50% overall, you have to look at it by sector. And you see construction, where all of us are, we are at 60% recovered. That's about tied with other services and trade, transportation, and utilities. An interesting thing about that, though, is we, as in the construction sector, were one of the quickest to come back. We were way outpacing the national average even just a few months ago. And now we've started to plateau at that 60%. And we're going to keep an eye on this. I do think this is not related to residential construction, though, and you'll see why I say that in a moment. I think a lot of this is because you also have the non-resi construction in this category that's pulling it down. There still is economic pain, though, as you look at this, whether it's professional business services, which is only 36% recovered, financial activities, 32% recovered, and some of these other sectors, government, information, mining, and logging, that are far, far off where they were just at the start of this year. Some of these sectors are very important to look at, though, because if you look at mining and logging, if you look at financial activities or professional business services, you have a lot of high-income individuals in those categories. So we want to make sure that as the months continue on, we continue to see those numbers trend up. But what does it mean? 1.4 million in August. Great. In normal times, that would be one of the best months, the best month we saw pre-COVID. But of course, we're living in a very strange world. What this data is telling us is right now our unemployment rate, depending on how you look at the data, is between 8 and 14%. Now, the 8% is your headline unemployment number. That's what you'll see on the front page of the Wall Street Journal. The 14% is a number you don't pay attention to when the economy is good. But when the economy is in a recession or recovering from a recession, the U6 will tell you how many people are working part-time, but gosh, they would love to be working full-time. So that shows some of the true economic pain. These numbers, while really high in a historical context, are encouraging because August was the first month we went below the peaks we saw during the great financial crisis. And what we kept saying every single presentation and every single conversation we had with clients was duration. You cannot get stuck at a 10% unemployment rate because if you do, the economic damage becomes way more widespread. Now, like I said, I like to show you the headline numbers, but I like to bring you a little bit of the counterbalance of other information as well. So while we are between 8 and 14% compared to 10 and 17% during last cycle, compared to February alone, we've had 3.7 million people drop out of the labor force. When you drop out of the labor force, you're no longer counted in the unemployment rate. And we've done some digging to find out why are people leaving. And partly is because, if you have an autoimmune disease, you don't want to be going to work, you have to step aside. The biggest and most dramatic reason, though, is childcare. When we have remote schooling, there have been parents. It does disproportionately fall on the women, but you're seeing a huge increase in men as well that are saying, this is unsustainable. I can't work from home. I can't take care of my children. This is really getting too hard. So these numbers are making the economy look a little bit better than what it really is, because if you add in those 3.7 million people, there's a very, very different unemployment rate that results. But then you want to look at the data by market. Now, what I've done here is I've gone through BMC's markets and I've looked at which are the ones that have a higher unemployment rate than the national average and which ones have a lower. And what you see here is it says August implied because we don't have the actual local unemployment rate just yet. We should be getting that this week. But I need you to pay attention to these markets, especially on this table, because you're going to see a recurring theme throughout this presentation. If you just look at the unemployment rate, which would have been something we would have done in a normal economic time, you would have looked at Las Vegas at an almost 16% unemployment rate and say, ugh, stay away from Vegas because that economy is crushed. Well, you certainly are seeing economic pain, and I do not want to diminish that, but if we talk about housing specifically, you're going to be amazed to see that some of these markets with the highest unemployment rates in the country have the best activity in home sales today. So remember the names: Las Vegas, Los Angeles, Sacramento, Phoenix, Houston, Seattle. These are crazy high unemployment rates, 8 to 16%. And then though, you see the list is a lot longer of BMC markets that are really, really strong, outperforming the national average. Salt Lake City with an unemployment rate around 4.5%. Really unbelievable. This combination, these are just well-placed markets. These are markets that either have a lot of in-migration, didn't have a lot of COVID cases, just generally have more diversified economies, not as much related to the service sector, and that's driving some of the strength there. So when we start on the economic situation, I want you to get the sense that I'm nervous, because I am nervous about where the economy is. I am nervous about the rate of growth. I'm nervous that not all sectors are growing at the same pace, and our world has changed a lot since March. That's the beginning tone. But then we shift. And we look at this standout sector, and it's amazing. What I want to start with is looking at the trough of home sales by the BMC markets, and I want to look at what happened to them in March and April. So if you think about how many homes should a builder sell per month per community, it completely varies. It depends on your price point. It depends on your location. But let's give a basic rule of thumb that you're looking for 2 to 4 sales per month. A lot of these markets were crushed in March and April. We were talking about how the market basically came to a standstill. None of us knew it was happening. Las Vegas got down to 1.2 sales per month per community. LA, 1.4, Denver, 1.7, really, really low levels. These were dark times. And when you look at these sales, they probably would have been lower had builders not said, tell me a price, I'll sell it. I just need to get rid of these homes. I don't want to have too much standing inventory. And then after 6 to 8 weeks, we saw something pretty miraculous happen. Look at these percent changes. This is the current average sales rate per community compared to where they were at the trough. Las Vegas, the #1 with the highest unemployment rate, is now almost selling 4 sales per month per community. Even if you don't trust that percent increase, because of course we know they were hit the hardest, that's an amazing sales pace. LA, up 111%, 3.4 sales per month. But I told you, remember the names, look down the list. Sacramento at about 4 sales per month. You can see Salt Lake City was one of those the best overall economies. You see that. Phoenix, I told you to remember. Houston, I told you to remember. Seattle, really, really just an incredible change. Now, why does it matter? Because I'm going to spend a little bit more time talking to you about different local strengths, but we need to step back. Yes, we operate in the housing industry, so for us, it's our livelihood. We care. But what else? The reason we truly care about this is because if you think about the wider economy and you think that there's pain out there, we know for every single home that we build, we create about 3 jobs. And these are not just construction jobs. These become trade jobs. These become finance jobs. These become banking jobs. These become consulting jobs. It's really important for the housing sector to hold up because it can keep the rest of the economy, at least to a certain extent, on track. Because again, you heard a lot of talk about people going and doing DIY. People do that when they're staying at home. That's really important. But we also know once people buy a home, they're going to go to Home Depot. They're going to work with a mortgage broker. They're going to work with a realtor. They're going to go to TJ Maxx. They're going to go to Target and Wayfair, and they're going to be spending money. And consumers represent 70% of the overall economy. This is critical. This is why we care. So let's look at the data a little bit more. Now, Thom, I loved that you called lumber Super V, but if you ask me, this is also a housing Super V. And I didn't know what to call it for so long. I just kept saying like a really good V. So I'm going to take that super V and run with it. August new home sales, according to our new home pending sales index, up 40% year over year. Think back to Tim's comments. Builders went into 2020 thinking this was going to be a good year. So did all of you. You would have budgeted for maybe 10% growth compared to 2019. You would have planned everything out as such. In builders' case, they would have had their lots in order. Okay, this is what we're going to sell. No one, not even the smartest forecaster, would have said activity would have been up 40%. And that's why you're starting to see those issues on the ground with the home building market. But as we look at this, what we have to be aware of is it's not that sales are concentrated in one part of the country. Any of the markets that have a really saturated blue are having a ridiculously strong year-over-year growth rate, 80% in some markets. So there's record-breaking growth. And again, if you look at where BMC is operating, these are really strong markets. Sacramento, up 70% year over year. And we were talking to an expert in the Bay Area, because if you read the news, what you imagine is that the Bay Area is absolutely a ghost town. No one wants to live there. No one wants to be there. But we talked to a builder that said, maybe people have left downtown, but they're just moving inland. A builder said that they sold as many homes in the past 6 weeks in the Bay Area as they did the first 6 months of the year. Now, I want you to remember a couple more of these markets, because later I'm going to show you the markets with the most millennials. You can see Austin is another one of those really, really high markets for overall activity. Denver's high on the list. You can see Salt Lake City's high on the list. We'll talk about that a little bit later. But as you fast forward, there becomes this interesting thing where I usually love year-over-year numbers, but we all know that the housing market is going stronger later into the year. So I wanted to also look at what's happened month over month. What's happened from July to August. Now, normally from July to August, you see home sales go down, but actually our data shows that sales are flat, and we have 40% of all communities that sold even better going into August. Now, if you look at the markets, this is where things also get interesting. As you can see, again, there are a lot of markets that are up year over year, month over month. So from July to August, Raleigh, still a lot of strength. Sacramento, Charlotte, Austin, Houston, the markets that I've been talking about. If you look at the markets that are down though, LA, Salt Lake City, Phoenix, Denver, I'm not ready to tell you to worry. Hey, this is telling us something. We've seen sales that have gone down a little bit from July to August, because I've had a lot of builders tell us that August is often one of their worst months. So come September, now you may be seeing this trend, and we do know that September has been a really, really strong month for the new home space. So when you step back then, you got to look at the builders and you have to say, well, what's going on for them? And just like the economy, builders are facing countervailing forces. There are so many, not just good things for builders, amazing things for builders, things to set them up for record years. Lack of resale inventory, low mortgage rates. The fact that pre-COVID in February, our housing market was amazing. And now you have all of those demographic tailwinds, plus you have this expanded buyer pool from work from home and school from home. We have people that are renting, that either they're just sick of renting, their amenities have been closed, or they're like, I don't want to be touching an elevator button. And I was planning on owning at some point, but today the math actually makes sense because of low mortgage rates. We know suburbs, which we'll talk about a little bit later, have become increasingly desirable, and builder confidence. When builders are confident, they're more likely to build homes. When they build homes, we create jobs. So it becomes this virtuous cycle. But there are some issues. And you heard a lot of that from our BMC team earlier. You have the lack of new home inventory. You have high land costs and limited availability. Entitlement and permitting delays. You have the supply chain issues. What you really heard earlier is this elongated time from start to completion that builders hadn't expected. They couldn't have. No one knew it was going to get this dramatic. Lumber pricing, of course, that you heard Thom talk about, and the inability to keep prices low and margins high. That one is one that really, really sticks out to me. So as you look at the supply chain issues, I feel like I'm probably preaching to the choir on this front, but we have been asking 300 division presidents across the country about any supply disruptions they've had starting in March. In March, April, May, June, builders were like, no, it's not really that big of an issue. Only 30% of builders said that supply disruptions were going to be pretty impactful this year. got up to 50% in July, and then rose to 80% in August, that supply disruptions are now becoming a very serious threat. You heard the team talk about it, so I'm going to just rush through this, but we're seeing it happen on the trade side, the appliance side, the lumber side, sometimes related to costs, sometimes related to tariffs, sometimes related to borders, sometimes related to businesses going under. So there are a lot of different factors that are playing here. But what it means ultimately for the builders' bottom line is they want to keep their margins steady. They don't want to have margin compression because their costs are going up. And so what they're doing and what they're allowed to do because of the demand environment is raise prices. So overall in the economy, we have 60% of new home communities that raised prices compared to 40% last year. But look at these markets: Phoenix, Denver, Las Vegas, Sacramento, San Antonio. These have over 60% that raised prices this year, the current month, compared to about 35 to 50% last year. So this is happening for two reasons. Reason one, costs go up, preserve your margins, raise it. We are not seeing consumers say, whoa, 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 I don't want to buy anymore. Consumers are saying, okay, this is a hot commodity. You have a very valuable asset. I want it. I'm going to continue to buy. The other reason is when you think back to what I said is if builders plan for 10% growth this year, they're burning through their inventory. They are selling homes and they want to sell the home, sell the home, sell the home. But now they need to temper that because they didn't plan to sell 10 or 14 homes per month. Think back to what I said earlier, 2 to 4 and you're happy in a normal environment. So builders need to slow that intentionally as well. So as we look at this though, what's driving the strength? Because I set up a pretty ugly economic picture and then we're hitting record levels, highest levels since 2006. I'm going to give Thom, he didn't actually say this out loud, but I saw on his slide this cocooning demand, the people wanting to stay home. I think he needs to be in PR, by the way, because he has some really good phrases. But when you're looking at that cocooning demand, that's one of those factors. People want safety. They want comfort. They want to be in their home. Their life stage has changed. Their lifestyle has changed. But as we look at who's shopping today, the number one answer is young families. Remember, I just showed you a slide about builders who are raising and raising and raising and raising prices. Right now, that's okay. That's getting absorbed. But when you have young families at a certain point, even with rates are low, you got to be careful how much you push it because that buyer is not flush with cash, at least not to the same extent that tied for the number 2 biggest buyer today would be the boomers. So we know millennials are the driving force. Right now, they're 29, they're 30 years old. People have been asking me for years, when are millennials going to be buying? And I've told them for years, stop waiting. They already are. But it's become even more exaggerated in today's environment. Millennials represent 40% of all of the transactions. And one of the questions you have to ask yourself is, well, that's great. But if you're operating in, Southwest or Southeast Florida, maybe you don't have a huge share of millennial buyers. Where do we find the largest population? I told you to remember some markets. Think back to Austin. Austin was one of the hottest housing markets right now. 30% of the overall population comes from this demographic. That's one of the highest in the countries. Seattle, you saw that the unemployment rate was really, really high, but you saw that home sales have actually improved quite considerably. Millennials are a big part there. Salt Lake City, Denver, LA, Houston, you're starting to see that common thread. Now, as we look at it though, I get very frustrated when I hear things about how there's a change in how people want to live. What we've known for the past 4 years is that millennials want to live in the suburbs. It was not the urban location. We had millennials that were equally as likely to live 1 to 10 minutes from work, so in this downtown location, as they were more than 30 minutes. So millennials were spread. I'll be downtown and I'll be really, really far out, maybe even in a rural location. The majority, though, were already, for the past 5 years, living 11 to 30 minutes from work. The suburbs were there. The suburbs were a preference, especially as millennials went to go buy homes. That's when you really, really saw that shift. So as we see more people buying homes, certainly we're seeing an increase in suburban activity, but this isn't a new shift. This is an exaggerated shift. What's been interesting, though, is remember I said to you, watch these millennials because they're the ones that are going to be cost-constrained, too. They are eager and ready to purchase homes, but you got to come up with a down payment and you got to come up with closing costs. And often those are hard to do. Well, one thing that we've seen, which is quite amazing, is that millennials haven't been able to get married this year. The Knot estimates 1 million weddings were scheduled between March and August, and they couldn't happen. Well, sure, now people are getting a courthouse wedding, or they're inviting 10 of their closest friends and family over, or they're pushing their wedding to next year. All of those result in a little bit of savings, and that's resulting in newfound down payment money. This is a trend that I found independently from my group of friends. I'm in the millennial cohort, and then my coworker, Tim Sullivan, he runs our advisory practice, but he's a boomer. And he talked to all of his friends who said, our children are buying homes because they can't get married. So this is a very, very real thing that we've seen. This is from someone that says, can't get married? Guess we'll buy a house. So you have that savings of the wedding. Maybe your wedding's less extravagant than you wanted. And we also have the fact that people are saving money. COVID has almost forced us to save money because we're not going anywhere. We're not getting on planes. We're not going to concerts. We're not going to bars. We're not buying new clothes anymore. And the personal savings rate now is at 20%, when normally it's between 6 and 8%. It had gotten up to 35%. This matters because housing, we are the beneficiary of this, because as people don't save money, spend money, they're saving, they use those savings for those big costs that normally hold people back. People can often pay the monthly payment, but they don't have that lump sum for either the closing cost or for the down payment. Now, this is not a new phenomenon. This transcends different generations. And what I want to talk about, which I don't often, are Gen Xers. Our Gen Xers right now are seeing a life stage change. They're working from home. If they're married, you have a couple that's working from home. Then you have kids that may be high school age, that they need their own space. So for the Gen Xers, they were really hit hard during the great financial crisis. Took them a while to get back into the home building industry. Now they're owning homes, but their life stage is changing and their equity is really high. All of those stars are where BMC is operating, and you can see they're in a lot of the markets that have that really, really high average equity gain year over year. So you see in California, it's 18,000. In Seattle, you're going up to 21,000. So for the Gen Xers, if you think about the move-up market, it's one of those markets that was there, it was growing, it was fine, but it was never an exciting part of the housing market. A lot of people were more focused on the millennials and the boomers. Well, now Gen Xers are really having their moment. But boomers too, really interesting. If you look at this data, it's showing you what percent of boomers have not moved since 1999, 21 years. In LA, it's almost 80%. Salt Lake City, you're at 70%, Seattle, Denver, San Antonio. There are a lot of reasons, tax being one of the biggest. You don't want to reset your property tax. You want to just be able to enjoy the home that you're living in. What we know is 83% of boomers do not need to move, and only 17% are dissatisfied with their current home. That's an uphill battle for boomers, because all of a sudden you can build something. It's not as easy as if you build it, they will come. If you build it, they need something compelling. They want something interesting that makes them want to move. And that's what we've seen with the boomers. It's been an interesting thing because boomers are more discretionary. They have the luxury of choice and time, and often the luxury of a little bit more money because of where, if they have home equity or if they have money in the stock market. What we saw is the active adult market came back in phases. So first thing we saw is starting probably in June, we started to see the active adult market come to life as long as the shoppers were local. I live in Denver, I want to buy in Denver. We saw them come back. Then we started to see those shoppers that were moving for a reason. We have a thing that we call a baby chaser index. We created this at Meyers Research, and we wanted to know, where are there a lot of millennials and where are there a lot of boomers that are following? The reason we say this is if you're a boomer and you have a millennial child, and then your millennial child has their own baby, well, you want to be close to them. That's a baby chaser. The grandparents follow the grandkids. And these are the markets that we've identified for the #1 for the baby chaser index. And overlay here, BMC's markets, and you can see that's actually a really strong overlap of, Austin again, Charlotte, Raleigh. You can see these consistent themes of why is housing doing well. There's a lot of markets that have a lot of upward factors pushing for them. Now, we have a third category, which are boomers that are moving for fun. These are the boomers that we're not seeing back in full force yet, which does mean good news for once we get past COVID, a strong vaccine, or life starting to look more normal, that group will come out and buy. But generally, we've seen boomers operating in or moving to parts of the Sun Belt and then, of course, the Northeast. So my final thoughts, 2 slides here, and we will wrap it up. The first is that as we look at the economy, I still want to emphasize, you can hear I'm enthusiastic and I'm excited about what's going on in housing, but it's not game over. There are still risks, and do not let them slip your mind. Because right now we are living through a K-shaped recovery. And K-shaped recovery means there are parts of the economy and people in the economy that this economy is working for them. The housing market, online retail sales, people that can work from home, people that have money in hard and soft assets. They are more profitable or more wealthy than they were in February of this year. That's the top half of the K. Amazing. V-shaped recovery for all of those sectors. What's not a V-shaped recovery? In-person retail, travel, tourism, conferences, concerts, people that can't work from home. Like I said, people that have to leave the workforce because of their kids, people that don't want to go to work because of COVID. All of those are really, really bad. They're less wealthy than they were in February. They are less profitable. A lot of businesses are going under. This is 2 different economies. And you hope that the top half of the K, the rising tide lifts all boats, but of course the virus is standing in the way. For housing, we're going to keep an eye on these main things. We're going to look at home equity, interest rates, consumer confidence in the stock market to tell us whether or not this growth can continue. Right now, 3 of the 4 are really strong: stock market, interest rates, and equity. Consumer confidence is a little bit wishy-washy, but don't forget about affordability. It's easy to think because rates are low that affordability won't be an issue, and that's wrong. And just don't forget that we can run into affordability and we can get into our own issues if we continue to push prices as quickly and as rapidly as we are right now. So with that, I will turn it back over to Jack and the BMC team.
Allie, awesome job. It's funny, all the questions, I've been in chats throughout all the presentations today, and everyone just keeps saying, you guys, all of our presenters are hitting the nail right on the head. Everything that you're seeing, they're sharing their own anecdotes. That's what they're seeing throughout their markets. As far as questions that we've received, I know we're kind of right here at the hour. I'll ask, one of the main questions is there going to be a copy of this webinar shared or a recording? The answer is yes. I'll definitely be sure that gets out here sooner rather than later. And I've only received really one question that's a pointed question, and that's for Allie, and it says, United Airlines and American Airlines are announcing major job cuts on October 1st. Do you know if other companies are also going to start dropping employment without any additional government stimulus?
150%. Yes, we are seeing, and because this was a 30-minute presentation, I wasn't able to hit on all of the trends that we're seeing, but that, like I said, I'm very cautious on the economy. I'm a little bit more bullish on housing, but we're already seeing a whole bunch of companies shed jobs. We're seeing Ralph Lauren has announced job cuts. Salesforce has announced job cuts. Citigroup, who promised not to do cuts this year, they're doing job cuts. We're seeing that, yes, the economy is opening. And for a lot of us, our life is starting to look more normal. We're starting to do a little bit more activity just with the inconvenience of wearing a mask. The problem is, a lot of these companies, yes, people are going back out, but they're still operating at 50% capacity or 75% capacity. That's either because of policy or because of people self-choosing, because we know a lot of people are just saying, I'm not going to put myself in harm's way. Companies can't stay profitable and they can't stay in business that long at 50% of what they were operating earlier this year. So if the stimulus continues to be this partisan politics, yeah, we run a really big risk of what happens to the economy going into next year. Hopefully the election helps solve that, though, whether we have a sweep from one side or the other in the election, that should help get more stimulus passed. We all hope.
And that was the follow-up question someone just pinged into me was, is there going to be impact of the election either way? And that definitely, as you alluded to, it sounds like there will.
Yeah, definitely. Yeah.
Okay, one more. I think we have time for one more question, even though we're over. I'm going to go ahead and ask this one. How do you foresee the mortgage impacted by furloughs hitting the market? Or the mortgages? How do you foresee mortgages being impacted by furloughs hitting the market?
Well, here's the funny thing. So I've talked to a lot of builders, and they have told me that when they have had people come in to buy a home that have said, I'm afraid of losing my job and I want to buy a home today. And I never knew people would think like that, but they said they want to lock in the rate and they want to lock in the payment and the security of keeping their payment low. So that's people that don't already have a home, is of course, we're seeing that. And I wouldn't say like a huge trend, but of course it's just something that builders find interesting and they share with me. Besides that, we do have the forbearance program going through the end of this year. And it's really interesting now because initially, if you put your home in forbearance, which by the way is not as high as anyone thought. I think all of us thought it would be way more, double the amount of people in forbearance. It's not as high as we thought. I think that's because we've had so much stimulus money and because people have been able to save so much money because maybe some of the stimulus helped them earn more money. That's why we haven't seen that. But going into the end of this year, some of the new policy says the mortgage lender can actually say, I need that lump sum payment. So if someone comes out of forbearance in January and they have to pay up for 3 or 4 months that they haven't paid, that's a huge issue. But the only thing I take solace in is into 2008, 2009, the great financial crisis. No one knew what a housing crisis would do to the economy and that it would take 10 years for the economy to recover and that people would be financially and mentally damaged for years and scarred. And the only good news that I can say that came out of that is we now know that if you let people lose their homes, that becomes catastrophic. And maybe I sound like Pollyanna, but I would like to believe that we've learned our lesson and there'll be some kind of extension so that people can get back on their feet.
Okay, thank you. I got one more question for you, Allie, and then I've got 2 questions for Thom, and we'll wrap this up in the next few minutes here. I'm basing this off of the fact that the majority of our hundreds of listeners are still staying on with us. They're interested in hearing what everyone has to say. So question for you, Allie, last one here. Looking at the U.S. as a graph, what quadrant, northeast, northwest, southeast, southwest, do you see recovering the best? And which one do you see recovering the least?
That is easy. Thank you for giving me that softball. I'm going to use that one again in a different one. So Southeast, for sure. No questions asked. Southeast is very, we have found that both the politicians and the people are a little bit more relaxed about COVID, for good or for bad, but that's been good for the economy. We have seen the Southeast is huge for positive net migration, people coming from almost everywhere else in the country. So people from the Midwest, people from California are now heading to the Southeast. I would say second to that, you can't call it really a quadrant, but Texas, of course, is doing really, really well, also with positive net migration. There are concerns, and I don't want to be a cliche here, but I have concerns for our cities that have had the highest unemployment rates, so in states, so Nevada's, California's, Louisiana, New York, New Jersey. I'm a little bit more anxious about their longer term economic recovery because they've had to pay out a lot. They've lost tax revenue and they've had to pay out a lot of unemployment insurance. And what that usually results in is a state budget that's not looking so great. And that sometimes comes with higher taxes, which you've seen already announced, at least to a certain extent in New Jersey. You could see that start going to some of those other markets. So when you start seeing taxes go up, you do see more people flee. I'm a little bit more anxious about that, but the one answer is Southeast is great.
Excellent. Thank you so much, Allie. All right, 2 more questions, both for Thom. Mr. Thom Black. Thom, you there?
Yep.
All right, so first question is, for lumber, OSB, TJ, and associated materials, when do you think that production will be equal to or greater than demand based on recent demand? Basically, when do you think there will be more of a balance of supply and demand, so equilibrium?
Okay, great question. I mentioned the comment during my slides about life not returning to normal until we're past this terrible virus, right? And as long as it's with us. The reality is that production was hit so drastically at the beginning of Q2, and one of my industry colleagues so eloquently put multiple times, everyone thought the boogeyman was going to show up in May and then in June and then July. And you know, I joked with you, Jack, the boogeyman swiped left, right? He never decided to show up, and as a result, we haven't been able to catch up. And the reality is, when you look at the Q2 production, We saw a drop off year over year. Basically, it was flat in Q1, but production in Q2 was down drastically and significantly in the U.S. Domestic West. It was down drastically. Now, when you take a step back, the basket that got hit the hardest, and using the backdrop of why we focused on items 5 and 6, and specifically the cocooning effect of the home center demand, you saw a huge impact on Southern Pine availability, and that was because that basket got hit twice. It got hit not only by the box stores directly, but it got hit by the box stores through the conduit of the treating, the pressure treated industry as well. So despite the fact that in 2019 there was more Southern Pine produced than there was in 2018, and theoretically in normal production times, you should have enough. I still stand with the comment, as long as COVID is with us, we won't see a normal balancing of supply and demand, because Allie's comments about discretionary income, I couldn't agree more with. I've shared that with suppliers for months. The fact is, those that were not affected by unemployment and were able to have, and for those like us who have the luxury of calling home building, the industry that we work in, I feel for that fact. But the reality is, have more discretionary income is spent on things that you would otherwise have spent on going to the movies, having popcorn, going out, going to vacation, whatever. And so long as people are, there's a sentiment of not putting themselves at risk, like Allie said, I believe that the supply chain will continue to be altered until such time that we either have a vaccine or this virus is behind us. It may feel like we get to some sense of normal as we get into Q4 here, and then perhaps to close the year if prices do come down. But again, their market deployment resources back towards organization after the first of the year. With organization comes redoing closets, redoing pantries, and then before you know it, you're right back into deck building season. So the question on the side that we are going to see a substantive change in availability. And on the OSB side, frankly, and that's a little bit more specific. There were 2 assets that were taken down Southeast, and just focusing there because Allie's comments about the Southeast and the strength. 2 assets that were taken down last year by 2 individual producers. And while one of them is running temporarily right now, both of those need to come back for there to be a better balancing of supply and demand with the current housing start numbers. So the question, Jack, I just think as long as COVID is with us and continues to hamper the supply chain, change the way people spend their money, and also work that supply and demand find equal balance.
All right. Hey, thank you very much for that thoughtful response, Thom. I think I'm just going to go ahead and wrap things up with that one. That was a great question, I think, to end on. So again, I want to say thank you to all of our presenters today, and as well as today's presenting sponsor, Weyerhaeuser, and for everyone who turned in, especially those of you who submitted questions here at the end. Our next market intelligence webinar will be hosted on October 23rd. We look forward to having you join us once again. Please help us spread the word if you found today's content valuable by telling your coworkers and other industry contacts about the series. And also a reminder, as I close out the webinar here, it would be awesome if everyone could just take 30 seconds, 1 minute to answer the brief 3-question survey I mentioned earlier, which will appear up on your screen as soon as I close things out. Thank you, everyone. Have a wonderful rest of your week. Take care.